All right, let's talk about something that gets ignored way too often in crypto, but is absolutely critical. Tokenomics. This is the hidden economic engine that really determines if a project is built to last or destined to fail. And by the end of this, you're going to know exactly how to tell the difference. Let's dive in. Sound familiar? This is the core problem, isn't it? We've all been there, mesmerized by a chart that's just going straight up. But that chart, it's only showing you one tiny piece of the puzzle. Honestly, ignoring the economics behind a token is pretty much the fastest way to get wrecked. Today, we're going to fix that.
So that's the million-dollar question, right? Think of us as detectives for the next few minutes. We're about to uncover the clues, the hidden signals that tell you whether a project is a solid bet or just, a house of cards waiting for a light breeze. Okay, first things first. Every good detective needs to know their tools. So, what in the world is tokenomics? It's not just some fancy buzzword. It's the absolute foundation of your entire investigation into a crypto project. To put it simply, tokenomics is the rulebook for a cryptocurrency. It lays out everything: how many tokens will ever exist, who gets them and when, and what they're actually used for. Understanding these rules is like getting a peek at the financial blueprint of a project before you invest a single dollar. All right, let's get into our first major area of investigation, the token supply. This is where so many people fall into what I call the cheap token trap. It's a super common mistake, but I promise, once you see it, you can't unsee it. You're going to want to jot these 4 terms down in your case file. The most important one for today's price is circulating supply. That's how many coins are actually out there trading right now. The other 3, total supply, max supply, and FDV, well, they give us a glimpse into the future. And, more importantly, potential future risks. Have you ever thought this, or at least seen someone screaming it on social media? It kind of makes sense on the surface, right? A super cheap token has way more room to grow than an expensive one. It feels like you're getting in on the ground floor. But this is the trap. This question right here is what separates a beginner from a savvy investor. A token's price, by itself, is probably one of the most misleading numbers in all of crypto. It's completely meaningless without context. It's a classic misdirection. And this table shows you exactly why. Look, token A is $10, while token B is just 2 cents. Token B looks like a massive bargain, doesn't it? But when you do the actual math, price times circulating supply, to get the market cap, the truth comes out. They're both valued at $100 million. They are equally expensive. That low price for token B is just an illusion created by its absolutely gigantic supply. And we can take this a level deeper. Check out this chart. This is a project where only 10% of the total supply is actually circulating. That means 90% is locked away. This huge gap between its current market cap and its fully diluted valuation, or FDV, is a major warning sign. That 90% represents a mountain of future sell pressure. We saw this pattern play out over and over again in past cycles. Projects launch with a tiny float, the price pumps, but then a year later, huge batches of tokens unlock for insiders in the team, and that dilution can crush the price. You see, supply isn't some fixed number. It's always changing. It's being pushed and pulled by these powerful, often invisible forces. You've got inflation, which adds new tokens, burns, which destroy them, and unlocks, which can suddenly flood the market. Any good investigation has to account for these. Wow, a number like this just grabs you, right? 500% APY? That sounds incredible. But a good detective's first question should always be, okay, where is this yield really coming from? Well, the answer is usually one of 2 things. You have sustainable yield, which is the good stuff. That comes from real economic activity, like trading fees the project earns and shares with you. But then there's unsustainable yield, which is what you usually get with these crazy high numbers. It often just comes from printing new tokens out of thin air. You're basically getting paid with freshly minted tokens, which inflates the supply and devalues everyone's holdings. This says it all, really. If you're earning 500% APY, but the token itself drops 90% because of that very same inflation, you're not making a profit. You're actually losing money. It's a total illusion of wealth, and it's a huge trap in crypto. Okay, here's another key event your investigation has to track: the vesting cliff. You need to get out your calendar and circle this date for any project you're into. It's a pre-scheduled day when a massive wave of tokens, usually held by the team and big early investors, are unlocked and can finally be sold. It's like a ticking time bomb for supply. And this is the classic pattern we see. As that unlock date gets closer, the market starts to anticipate it. People know a flood of supply is coming, so the price might start to weaken even before the unlock. Then, when the day finally hits, all that new supply can create even more downward pressure. Now, not every unlock leads to a dump, but it's a huge risk you have to be aware of.
So we have thoroughly investigated the supply side of things. Now let's flip it over and look at the other side of the equation. Demand. What actually gives a token value? Does it have a real, concrete purpose, a job to do, or is it just running on pure hype? This is basically your checklist for strong evidence. Is the token essential for paying fees on the network? Do you need it as collateral for something? Does staking it actually help secure the network? Does it get you a share of the revenue the project makes? If you're ticking off a few of these boxes, you're looking at a token with real, genuine utility. And on the flip side, here are the giant red flags. Vague, fluffy language like it will be used in our ecosystem means absolutely nothing. If its only purpose is to let you vote, or worse, if the product works perfectly fine without the token, you have to ask yourself, why does this thing even exist? And a lot of the time, the honest answer is just to raise money for the founders. This is such a critical distinction. Think of it like this. A popular city park creates tons of value for the community, right? That's value creation. But if there's only one ice cream stand allowed to sell there, that stand is the one doing the value capture. A crypto project can be a super popular park with tons of users, but if its token has no mechanism to be that ice cream stand, its price might never reflect the project's success. We have covered a ton of ground, from supply dynamics all the way to token utility. So now, let's put all of our clues together into one simple toolkit you can use to wrap up your case on any project. Here it is, your 5 essential questions. 1. Supply. How big is that inflation bomb waiting to go off? 2. Distribution. Are a few insiders holding all the cards? 3. Yield. Is that APY real or is it just fancy inflation? 4. Unlocks. What does the release schedule look like? And finally, the most important question of all, token role. Why does this token absolutely need to exist? If you can answer these 5 questions, you'll be light years ahead of most people in this space. And that's our deep dive into tokenomics. You now have the tools to look past the price chart, to look beyond the hype, and to actually understand the economic health of any crypto project out there.